So not a lot of movement, as you saw on the TSX today, but we have already seen several record closes this year. Let's start there with Karl Berger, senior wealth consultant and investment counselor at Cidel Asset Management. Thanks for joining us today.
Nice to be here, Marilla.
Is the TSX mostly benefiting at the start of the year from the run-up that continues in gold?
Yeah, it's a pretty similar story to how we ended last year and really the whole last quarter of last year. Gold prices remain strong. There's certainly interest in the sector, but there's actually a lot of decent things going on in Canada right now. There's a fair bit of confidence amongst CEOs across Canada in terms of where the Canadian economy is going. I think a lot of people are surprised that we're holding up quite as well as we are. So there's a bit of broad support, although the euphoria in the TSX is certainly concentrated in the materials sector.
Okay, how much of the movement in gold do you attribute to what's going on in the U.S., meaning the uncertainty of a Trump administration?
Oh, wow. I mean, I think most of any theme like that relates to the U.S. at this point, and whether it's precisely what the Trump administration is doing or the level of U.S. indebtedness, the propensity and the requirement for the U.S. to borrow consistently over the next number of months and years. I think a lot of it comes back to the policies and to the way things are playing out. I don't know that gold is entirely a fear or chaos story. I think there has been a demand from central banks in particular, so there is a real aspect to that part of the story, but it is multifaceted at this point, and it's a fascinating topic for investors because it really comes down to risk tolerance and risk appetite. You know, it would be really easy to make a case for gold going to $5,000 an ounce, $6,000 an ounce, $8,000 an ounce, pick a number. It would also be fairly easy to make a case for it going back to 3,000 and that really being simply a retracement or a correction in the very, very strong move that we've seen over the last couple of years. It's difficult to invest in that sort of dynamic when there isn't a cash flow associated with it. And yet gold has been a massive story, obviously, and is going to continue to be.
Okay. Can I get your take on Canadian energy as well? With the recent changes in Venezuela, what are your thoughts about the Canadian energy space moving forward? Because people were very bullish on it last year with the build out of the AI data centers. And I'm looking at the price of oil and what's going on with Venezuelan oil and wondering what you see ahead.
Yeah, I think I'd say we're generally a bit cautious on the sector overall, mostly from a supply standpoint. So what happens if all kinds of Venezuelan oil comes on the market? And it certainly isn't coming on anytime soon, or at least not in any kind of quantity. We think about the potential for a resolution to the conflict in the Ukraine at this stage and what happens if sanctions against Russia are unwound. So the supply side of the oil dynamic still seems to be not necessarily supportive of the price of oil overall. And the Canadian industry is fairly well situated to take advantage of it. Canadian firms are returning have an awful lot of cash that they're in the process of returning to shareholders. So it's not a sector that we're heavily invested in at Cidel, primarily because we like to be able to focus free cash flow generation and model out what we expect companies that we own to produce over the next 5 or 10 years. And that's really, really difficult to do with any kind of certainty when you don't know whether oil is going to be $60 a barrel or $80 a barrel or $50 a barrel. But we do have some exposure in the Canadian oil patch, and we're not uncomfortable with it.
All right. You've been watching or keeping a watch of indicators for a bear market. The first one I know you pay attention to is inflation. We have new data out in the U.S. What does it tell you?
So inflation is still uncomfortably sticky, I would say, and at a level that is higher than the U.S. is comfortable with, and that investors should be comfortable with, certainly higher than the Federal Reserve is comfortable with. On the good news side of things, it hasn't gone significantly higher, and I think a lot of people worried about that from a tariff standpoint. But in terms of where we're at, in terms of that as an indicator, I'd say inflation is not a huge red flag for us at this point. It's not suggesting that a bear market is imminent or strongly headed in that direction.
Tech valuations, of course, or valuations in tech, the tech sector became an issue more for North American investors at the end of last year. People started worrying about all the spend on the AI data centers and what it would amount to in the end. Are valuations still a concern for you this year?
Valuations are always a concern, but tech valuations are fascinating because of exactly the dynamic you mentioned. There's all of this spending on AI. Sooner or later, it's going to have to create a tangible return. And with the volume of spending or the quantum of spending, that return is going to have to be absolutely significant. And we don't necessarily see where that new revenue is going to come from at this point. And it still sounds like there is going to be incredible spending on the concept in 2026, 2027, and beyond. So it seems like it's still supportive of things of the economy at this point, of corporate profit growth. That's certainly something to be cautious of, but it looks like 2026 is going to start the same way 2025 ended in that regard.
Okay, so Karl, when you take a step back and you look at the indicators for a bear market overall, what are you seeing?
Overall, there's nothing that screams to us that a bear market is imminent. Inflation is, as I mentioned, under control, not going higher, not probably as low as we'd like. Central banks are not reacting in a hostile manner. They're not raising rates really anywhere. Term rates are going a little bit higher because of concern over inflation in the future, but that's not a huge concern. There isn't incredible investor sentiment. There's not irrational exuberance, to go back to Greenspan's quotes or terms from the 1990s. Valuations, as we touched on in the tech sector, are a little bit robust. In other parts of the economy, really aren't that challenging. So overall, I mean, there's nothing to say that we won't go into a bear market at some stage. There's nothing to say that certainly nobody's waving the all clear flag, suggesting that it's okay to take risk at this point. But I would say that at best or at worst, the indicators are neutral at this stage, and that there's nothing that imminently suggests to us that a bear market is coming.
Got it. Karl Berger, thanks for joining us today. Appreciate your time.